Hello everyone. Let's talk our way through this practice about changes in stockholders' equity. So what we have here in our practice is our stockholders' equity section of American Eagle's balance sheet. So we have preferred stock with nothing, so we're going to not have anything to do with that. Often it is listed even though there's zero there. We have common stock, and we have some information. We have its par value. We know that there are this many shares issued, and we know that this many shares are outstanding at the end of 2017. Contributed capital or additional paid-in capital. We have accumulated other comprehensive income. We have retained earnings, and we have treasury stock. All of these, this is the number of shares and this is how much we paid for it. All of these are going to become our beginning balances for 2018. So this is the transactions that changed our stockholders' equity during 2018, and then we need to look at the journal entries that are going to record these changes. We're going to prepare a statement of changes in stockholders' equity, the equity section of the balance sheet, and calculate basic earnings per share. So let's go to our Excel spreadsheet and consider our various pieces with regard to what our journal entries might look like. So first of all, we have options going in the order that they were presented in the problem. The value of the options when they were given is 15,000. Everything's in thousands, so that's actually 15 million, but we're just going to go ahead and refer to it as 15,000 thousands. The value after forfeiture, when employees leave and don't exercise their option, they forfeit those. So we're down to 60% or 9,000. So we know that that is how much compensation should have been earned over the 5 years, which is 2014, 15, 16, 17, and 18. We're worried about 18. We know that 7,000 had been already recorded through the end of 17. And so that means we need to record another 2,000. And so our journal entry will be debit compensation expense and credit additional paid in capital. Which of course is an increase to our additional paid in capital. So we buy the stock, treasury stock, twice. And so we make two journal entries, debiting treasury stock and crediting cash. The first time we're going to buy 4,167 shares. The second time, because the price changed, it's 3,846. So we'll keep this in mind for later calculations, but it does not affect the journal entry. When the stock options are exercised, the employees pay us cash, so we debit cash. They get stock in return, and we're going to use treasury stock to give them that, which means treasury stock is going to go down, and the difference between what we paid for it and what they paid for to get those is additional paid in capital. So because we're going to do a stock dividend split, we need to know how many shares outstanding, because only the shares outstanding are going to get the stock dividend. That would apply to cash dividends, stock dividends, any of that. Only the shares outstanding receive that, you might say, those extra shares. So our shares outstanding, as we saw on our original paper, started the year at 194,516. We bought treasury stock twice. This number and this number together is going to reduce our shares outstanding by 8,013. We're going to increase by the number of by the options exercised, they were 2,000. So our shares at the point that we do our stock dividend, or towards the end of 2018, is 188,503. Okay, so we would give them exactly, everybody would get exactly one more share, so that's 188,503 shares that are additional shares that are given out. That's a 100% increase. So when we use a large stock dividend, we record it at par, and par was, as we noted on our balance sheet, 1 cent. So we're going to multiply the number of shares here times 0.01 or 1 cent, and we're going to have a debit to retained earnings and a credit to common stock for that amount as to record the stock dividend. Now that we've doubled our shares outstanding, then we can calculate the cash dividend, debit to retained earnings for our dividends, and credit cash for the number of shares outstanding times 2 times the 40 cents. So now that we have our journal entries, or our changes to the stockholders' equity, we can do our statement of changes. You can see the stock split affected retained earnings and common stock, made the common stock go up, made the retained earnings go down. Dividends made retained earnings go down. Net income made it go up. Here's the unrealized gain that we kind of glossed over as we went over earlier. The journal entry would have been increase in other comprehensive income and an increase or debit to the investment. We had two things that affected additional paid-in capital, or contributed capital as American Eagle calls it. The shares issued for options from the journal entry, 20,000, and the compensation earned from our very beginning journal entry. We also affected a treasury stock by the 20,000 and for our purchase. So here's the changes in the middle, and then here's our ending balances dollar-wise for the balance sheet. So this number comes down and becomes our common stock number. We change the number of shares issued by this new stock dividend split, and so it goes up, and you notice that shares issued times 0.01 is going to get, or the par value is going to be our number in common stock. Contributed capital comes down here, AOCI comes down, retained earnings, and treasury stock. We started with 55 or so thousand shares in the treasury. We bought twice, so it went up to 63. They do not get doubled. They do not get dividends when they are in the treasury. So they do. So there was no additional shares in the treasury in terms of the stock dividend. And our last requirement is to calculate basic earnings per share. So we need our net income. Preferred dividends were 0 because we have no preferred stock currently outstanding. And so the top number on our ratio is 95,255 still. Then we need our weighted average shares outstanding. So we started the year with 194,516 for January and February. Then it went down by our first repurchase. Then it went up by the shares. Sorry about that. That was, I had 1,000 shares there instead of 2,000 that we issued to folks because of the stock options. So I fixed that. That goes up to 192. That's for July through October. All right. And then again, we went down by the number of shares purchased in the second purchase of treasury stock. And that would be the case for 2/12 of the year. All right. And so that would be our calculation, except we know that that has doubled. So because of the stock dividend, and the easiest way to do that is just wait till we get to the end, and we can multiply each of these by 2, because when there is a stock dividend like that, it is treated as if it happened at the beginning of the year, even though this happened at the end of the year. All right, so our WASO is not the 191, it is the 382, and yeah, we're gonna let it go ahead and round, and our basic earnings per share is 25 cents a share. So that stock dividend changed our WASO made it double. So that is how that should have happened, and then you'll have things in place for doing your homework on this in this area.